There is a reason why some investors sleep peacefully at night, while others watch the stock market with fear every single morning. The difference is not luck, and it is not connections or insider information. The difference is a system, a discipline, and a deep understanding of what a business is truly worth at its core. Value investing is that system. It has produced some of the wealthiest, most respected, and most consistent investors the world has ever seen. It started with one man's bold idea during one of the darkest periods in financial history, and it grew into a philosophy that stood the test of time through market crashes, economic collapses, and the rise of entirely new industries. Bruce Greenwald, a professor at Columbia Business School and one of the foremost authorities on value investing in the world today, has brought this philosophy to life in a way that is practical, honest, and deeply rewarding for any serious investor. This is the journey that begins with Benjamin Graham, travels through the brilliant mind of Warren Buffett, and moves forward to the great investors who have carried this legacy into the modern world. Let's begin. The story of value investing does not begin in a comfortable boardroom or a quiet university library. It begins in the chaos and devastation of one of the greatest financial catastrophes in human history. The year was 1929, and the world was about to change forever. The stock market in the United States had been climbing for years, fueled by speculation, borrowed money, and an almost religious belief that prices could only go up. Then, in a matter of months, everything collapsed. Fortunes that had taken generations to build disappeared overnight. Banks failed. Businesses closed. Millions of ordinary people lost everything they had. The market, which many believed was the engine of wealth and prosperity, became the source of fear and ruin. It was in this environment that Benjamin Graham began to ask a question that almost nobody else was asking at the time. Instead of asking when the market would recover or which stocks would bounce back the fastest, Graham asked something far more fundamental. He asked, what is a business actually worth? Not what people are willing to pay for it in a moment of excitement or panic, but what is it truly, fundamentally worth, based on the real assets it owns, the real profits it earns, and the real future it can reasonably expect. This question, simple as it sounds, was revolutionary at the time. And the answers Graham found to this question became the foundation of one of the most successful investment philosophies ever created, a philosophy that continues to generate outstanding results in markets around the world to this very day. Graham was born in London in 1894, but grew up in New York. He was a brilliant student, and after graduating from Columbia University, he went to work on Wall Street. He excelled at analyzing businesses, and he quickly developed a reputation for finding stocks that were priced far below what they were genuinely worth. But it was the crash of 1929 and the Great Depression that followed that truly sharpened his thinking and gave him the opportunity to test his ideas under extreme conditions. He watched the market destroy wealth on a scale that most people could not comprehend. He also watched the market create tremendous opportunities for those who had the patience and the discipline to look past the panic and see the real value underneath. Graham's great insight was that the stock market is not a precise measuring instrument. It does not tell you, with perfect accuracy, what a business is worth. Instead, the market is driven by human emotions, by fear and greed, by excitement and despair. On any given day, the price of a stock might reflect a moment of irrational optimism or a wave of irrational fear. But underneath all of that noise, the business itself has a real value. It has real assets. It earns real profits. It serves real customers. And that real value, Graham argued, does not change every time the market swings up or down. The market price and the intrinsic value of a business are two completely different things, and the confusion between the two is the source of both the greatest mistakes and the greatest opportunities in investing. This is where Graham introduced one of the most important characters in the history of investing, a fictional man he called Mr. Market. Graham asked his students to imagine that they owned a share in a private business, and every single day, their business partner, Mr. Market, would knock on their door and offer to either buy their share of the business or sell them his share. The important thing about Mr. Market is that he is emotional, unpredictable, and sometimes completely irrational. Some days, he is wildly optimistic and offers an extremely high price. Other days, he is deeply depressed and offers an absurdly low price. The brilliant investor, Graham argued, should not be guided by what Mr. Market offers. Instead, the brilliant investor should look at the business itself, understand what it is truly worth, and then take advantage of Mr. Market when he is being irrational. When Mr. Market is overly pessimistic and offers a very low price, the smart investor should buy. When Mr. Market is overly optimistic and offers a very high price, the smart investor should sell. The key is that the investor should never let Mr. Market's mood determine how they think about the value of the business. This metaphor is so powerful that it remains at the heart of value investing to this day. Every serious investor must fully internalize this idea before they can truly practice the discipline of buying value rather than chasing price. But it also raises the most important question in all of investing. How do you figure out what a business is actually worth? This is where Greenwald's work becomes so valuable, because he does not just tell you that value matters. He shows you, step by step, how to calculate it using a framework that is logical, repeatable, and grounded in the economic reality of how businesses actually create wealth. Greenwald identifies three main ways to think about the value of a business. The first is asset-based valuation. The second is earnings power value. The third is franchise value, which comes from a company's competitive advantage. Each of these three approaches gives you a different piece of the puzzle, and together they give you a complete picture of what a business is worth and why the market might be pricing it differently. Understanding all three and how they relate to each other is the foundation of Greenwald's entire framework, and it is what separates a genuinely analytical investor from someone who simply picks stocks based on tips or market trends. The first approach, asset-based valuation, goes all the way back to Graham's original method, and it is the most concrete and verifiable starting point for any valuation. The idea is straightforward. A business is worth at least as much as the value of all the things it owns. If you were to take a business apart, sell everything it owns, pay off everything it owes, and hand the remaining cash to the owners, how much would each owner get? That number is the liquidation value of the business, and it represents the absolute floor of what the business is worth. Graham was a master at finding businesses that were selling in the market for less than their liquidation value. These businesses were so cheap that even if you shut them down entirely and sold everything off, you would still make a profit simply by being the owner. Graham called these businesses net nets because he would take the net current assets of the business, meaning all the cash, inventory, and money owed to the company in the short term, and subtract everything the company owed to anyone, short term and long term. And if the result was more than the market price of the company's shares, then the company was selling for less than its liquidation value. Buying businesses at these prices is about as close to a sure thing as investing ever gets, because even in the worst case, even if the business never improves, the value of what it owns exceeds what you paid to own a piece of it. This approach worked extraordinarily well in the years following the Great Depression, when the stock market was so beaten down that thousands of businesses were trading at prices that made absolutely no rational sense. Graham and his partner, Jerry Newman, made enormous amounts of money buying these deeply undervalued businesses and waiting for the market to recognize their real value. The strategy was so simple that it almost seemed too easy, yet it worked consistently because the market was so overwhelmed by fear that rational analysis had been completely abandoned. But Greenwald is careful to explain that asset-based valuation on its own has important limitations that must be understood and respected. Assets are only worth what they can earn. A factory full of machinery that cannot produce anything useful is not worth very much, regardless of what it costs to build or what the accounting records say it is worth. Land in a location where nobody wants to be is not worth its book value. The key to making asset-based valuation work is to adjust the stated value of the assets for their actual usefulness and earning power in the real world, not just in the ledger of the accountant. Cash is worth exactly what it says. Inventory must be adjusted for how likely it is to be sold and at what price. Real estate must be valued at its current market price, not its historical cost. Buildings and equipment must be valued based on what they could actually be sold for or what it would cost to replace them in today's market. This process of adjusting assets to their real-world value is something that Greenwald explains in careful detail, and it is a skill that separates great value investors from average ones, because many companies report their assets at historical cost, meaning what they paid for things years or even decades ago, which may have very little relationship to what those assets are worth today. A piece of land purchased 50 years ago may be worth many times its original cost if the surrounding area has developed and become more desirable. A piece of specialized equipment built for a specific product may be worth far less than what the company paid for it, especially if that product is no longer in demand or has been superseded by a newer technology. The value investor must learn to see through the numbers on the balance sheet and understand the real economic value of what a company owns, which requires both financial literacy and genuine knowledge of the industries and businesses being analyzed. There is also the important concept of replacement cost, which Greenwald uses extensively throughout his framework, and which represents one of his most important contributions to the theory and practice of value investing. The replacement cost of an asset is what it would cost a new competitor to build that asset from scratch today. This is a crucial concept because it tells you how difficult it would be for a new player to enter the market and compete with the existing company on equal footing. If a company has built a distribution network over 20 years, and it would cost a new competitor an enormous amount of money and time to build a similar network, then that distribution network is a valuable competitive advantage that should be reflected in the company's value. But if a competitor could easily replicate the company's assets at a low cost and in a short time, then the company does not have a durable competitive advantage, and the investor should be much more cautious about paying a premium for that business. Once you understand the value of a company's assets, the next step is to understand what those assets can earn. This is where the second approach, earnings power value, becomes essential to the analysis. Greenwald defines earnings power value as the value of the company if it continues to do exactly what it is doing today, with no growth and no change in its competitive position. It is the value of the company's current earnings, assuming those earnings are sustainable, repeatable, and not distorted by unusual one-time events or by accounting choices that make the earnings look better or worse than they really are. To calculate earnings power value, you start with the company's current earnings and make several important adjustments. First, you adjust for any unusual or one-time items that inflated or deflated the earnings in a particular year. A company might have had a huge gain from selling a piece of property, or a huge loss from a natural disaster, or a large restructuring charge from closing down a division. These one-time events tell you nothing about the company's ongoing earning power, so they must be removed from the calculation to arrive at a true picture of normalized profitability. Second, you adjust for the amount of money the company must spend just to maintain its current operations at their current level, which Greenwald refers to as maintenance capital expenditure. A company that appears to earn a lot of money might actually be spending very little on maintaining its equipment and facilities, which means those earnings are not sustainable because eventually the equipment will wear out and need to be replaced or repaired. The difference between the accounting depreciation expense, which is a standardized estimate, and the true maintenance capital expenditure needed to sustain current earnings is an adjustment that many investors overlook, but that can be very significant in capital-intensive businesses. After making all these adjustments, you arrive at what Greenwald calls normalized earnings, which represent the true ongoing earning power of the business under normal operating conditions. Then, to turn those earnings into a value, you apply a capitalization rate, which reflects the cost of capital and the risk profile of the business. In simple terms, if a business earns a certain amount each year on a sustainable basis, and investors expect to earn roughly 10 units of return for every 100 units of capital they invest in a business of this risk level, then the business is worth roughly 10 times its annual normalized earnings. This is a simplified explanation, but the fundamental principle is sound. The earnings power value gives you a clear, concrete measure of what the business is worth based on what it actually earns, not on speculative assumptions about how much it might earn in some future scenario that may or may not materialize. Here is one of the most important insights in Greenwald's entire framework, and it is an insight that reveals something profound about how to think about the relationship between assets and earnings. If the earnings power value of a business is roughly equal to the asset value of the business, then the business is earning a normal return on its assets. It is not particularly special. It does not have a strong competitive advantage. It is just doing the average thing with average results. In this situation, the investor can feel reasonably confident that the earnings are sustainable, because there is no obvious reason why competitors would rush in and destroy the company's profitability, since they would only earn the same normal return that the company is already earning. However, if the earnings power value is significantly higher than the asset value, then something very interesting is happening. The company is earning far more than a normal return on its assets. This is only sustainable if the company has some kind of competitive advantage that prevents competitors from rushing in and competing away those excess profits. In a perfectly competitive market, if a company is earning very high returns on its assets, other companies will notice and will rush in to compete, adding capacity, lowering prices, and driving profits lower until returns fall back to a normal level across the industry. The only way for a company to maintain above normal returns over time is if it has something that competitors cannot easily replicate. This is what Warren Buffett calls an economic moat, and it is the key to understanding the most valuable and most powerful businesses in the world. And this brings us to the third and most powerful component of Greenwald's framework, which is franchise value, the extra value a company has because of its competitive advantages. A company with a strong competitive advantage, or franchise, is worth far more than just the value of its assets or even its current earnings. It is worth more because it can maintain high returns on its assets for years or even decades into the future, generating a compounding stream of profits that is extremely valuable when you consider the effect of time and reinvestment. This is the kind of business that Warren Buffett loves, and it is the key insight that Buffett added to Graham's original framework, extending the philosophy of value investing from a focus on cheap assets to a deeper appreciation of the quality and durability of a business's competitive position. Graham was brilliant at finding cheap businesses. He was a master at identifying companies that were trading far below their asset value or their earnings power value. But Graham did not place as much emphasis on the quality and durability of a company's competitive advantage as he probably should have. He was primarily looking for cheap stocks that the market had mispriced for whatever reason. Buffett took Graham's framework and added an entirely new dimension to it. Buffett realized that the best investment is not always the cheapest stock. Sometimes, the best investment is a company with such a powerful competitive advantage that it can compound returns for investors at high rates for many years, even if the initial price seems a bit high by Graham's more conservative standards. To understand why competitive advantage matters so much, you need to understand what happens in a market without it. In a competitive market, when a company starts earning very high returns, competitors notice. They invest in similar businesses, they try to take customers away, and they lower their prices to win market share. Over time, This competition drives returns down toward a normal level, and the company that was once incredibly profitable becomes just average. This is the natural tendency of capitalism, and it is why most companies, over long periods of time, earn returns that are not dramatically different from the cost of capital. The excess returns get competed away, and what was once a special business becomes an ordinary one. But some companies are protected from this competitive pressure. They have something that makes it very difficult or impossible for competitors to take their customers away, and this protection allows them to earn above normal returns year after year. Greenwald identifies several sources of competitive advantage, and understanding these sources is critical for any serious investor who wants to identify the truly great businesses that can compound wealth over the long term. The first and most powerful source of competitive advantage is customer captivity. This occurs when customers are so attached to a product or service that they are very unlikely to switch to a competitor, even if the competitor offers a lower price or a seemingly better product. Customer captivity can come from habit. If you have been using the same product for 20 years and it works perfectly well, you are probably not going to switch just because a competitor comes along with something slightly different or marginally cheaper. The cost and disruption of changing your behavior simply is not worth the modest benefit. Customer captivity can also come from switching costs. If switching from one product or service to another requires a lot of time, money, learning, or disruption to your business, then you are much less likely to switch even if the new option is somewhat better or cheaper. A business that has embedded itself deeply into a customer's operations, processes, or habits creates high switching costs that protect it from competitive pressure. And customer captivity can also come from search costs. If finding and evaluating a new supplier or product is very expensive or time-consuming, customers will tend to stick with what they know and trust rather than risk the uncertainty of something new. The classic example of customer captivity in Greenwald's work involves enterprise software companies. Once a business has implemented a particular software system, trained all its employees to use it, integrated it with all its other systems, and built its operations around it, the cost of switching to a new system is enormous. Not just in terms of money, but in terms of time, disruption, risk, and the learning curve that comes with any new technology. So the software company that wins a customer initially can often keep that customer for many years, charging renewal fees year after year, with very little risk of losing the customer to a competitor who comes along with a somewhat better product. This is a powerful competitive advantage because it creates a predictable, recurring revenue stream that is very difficult for competitors to disrupt, no matter how superior their product might be. The second source of competitive advantage is cost advantage. Some companies can produce goods or services at a significantly lower cost than their competitors, and this cost advantage gives them a powerful edge in any competitive situation. If a company can produce a product at a much lower cost than anyone else, it can either charge the same price as competitors and earn higher profits, or it can charge a lower price and attract more customers while still earning a decent profit. Either way, the low-cost producer has a structural advantage that is very difficult for competitors to overcome. Cost advantages can come from several sources. One is proprietary technology or processes that allow the company to produce more efficiently than anyone else. Another is access to unique resources, such as a mine that produces a raw material at very low cost because of its location or the richness of its ore. Another is economies of scale, which occur when a company is so much larger than its competitors that its fixed costs, spread over a much larger volume of production, result in a much lower cost per unit than any smaller competitor could possibly achieve. The largest player in any industry where fixed costs are high and variable costs are low will typically have a significant cost advantage over smaller competitors, and this advantage tends to grow as the leader grows and the smaller players struggle to keep pace. This brings us to the third source of competitive advantage, which Greenwald considers particularly important and which is often underappreciated by investors who think about competitive advantage in terms of global or national scale. This is the economies of scale advantage in a local or regional market. Greenwald makes a very subtle but critically important distinction here. Many investors think about economies of scale in terms of large national or global companies. They assume that the biggest companies in an industry will always have the best economies of scale. But Greenwald points out that what really matters is the relative scale of a company within its served market, not its absolute size in the world at large. A company can have a very significant cost advantage if it is the dominant player in a specific local or regional market, even if it is not particularly large in absolute global terms. Consider the example of a local newspaper in a specific city. Even if the newspaper is not large by national standards, if it is the dominant newspaper in its city, it has significant advantages over any potential competitor who might want to enter that market. It has the most readers, which means advertisers will pay more to advertise in it because they reach a larger audience. It has more advertising revenue, which means it can hire more journalists and produce a more comprehensive and higher quality product. This creates a virtuous cycle where dominance leads to better resources, which leads to a better product, which leads to more readers, which leads to more advertising revenue, which makes it even harder for a competitor to challenge the dominant newspaper. The key is relative dominance within a defined market, not absolute size across all markets. Similarly, a company that dominates a specific geographic market, whether that is a grocery chain in a particular region, a cable company in a specific set of towns, or a hospital in a particular community, can have strong economies of scale advantages that make it very difficult for a competitor to enter and survive. This is because the competitor would have to spread its fixed costs over a much smaller volume of customers, while the incumbent benefits from established customer relationships, brand recognition, and lower per-unit costs due to its higher volume. The challenger would need to operate at a loss for a very long time to build enough scale to compete effectively, and most potential competitors are not willing to sustain those losses long enough to become genuinely competitive. The fourth source of competitive advantage that Greenwald discusses is network effects, and this concept has become increasingly important as more and more businesses in the modern economy are built on platforms and networks. A network effect occurs when the value of a product or service increases as more people use it. The classic example is a telephone network. One person with a telephone can call nobody. Two people with telephones can call each other. As the network grows to millions of users, each individual user gets enormous value because they can call or be called by millions of people. This makes it very difficult for a new telephone network to start up and compete, because a new network with only a few users offers very little value, while the established network with millions of users offers enormous value. The more people are on the existing network, the harder it becomes for any competitor to offer a comparable level of value with a smaller network. In the modern economy, network effects are present in an enormous range of businesses. Social media platforms, payment networks, online marketplaces, professional networking sites, and many other types of businesses benefit from powerful network effects that make it very difficult for competitors to challenge the established leaders. Once a platform reaches a critical mass of users, it becomes almost impossible to displace because the value of the network to any individual user depends on how many other users are on it, and the established leader always has more users than any challenger. Investors who understand network effects can identify businesses that, once they reach a certain scale, become almost impossible to dislodge, making them some of the most valuable and defensible investments available. With these four sources of competitive advantage clearly in mind, and with the three components of value, which are asset value, earnings power value, and franchise value, the value investor has a complete toolkit for analyzing any business and determining what it is truly worth. But Greenwald goes further and explains how to use these tools in practice, showing how real investors have applied these principles to real businesses over many years and in many different market environments to generate extraordinary returns. This is where the work transitions from theory to practice, and where some of the most interesting and instructive material appears. Several investors are profiled who have successfully applied the principles of value investing in different ways and in different markets, and each of them offers important and distinct lessons about how to adapt the core principles to different situations, different personality types, and different areas of the market. Before exploring these investors in detail, it is worth spending more time on Warren Buffett, who represents the most important evolution of value investing since Graham himself established the philosophy. Buffett started his career as a pure Graham-style investor, looking for stocks that were so cheap they were essentially trading below their liquidation value. He was enormously successful at this approach. His early investment partnerships generated returns that seemed almost unbelievable at the time, and he built a reputation as one of the most skilled practitioners of Graham's methods. But Buffett's thinking evolved significantly over time, partly through his partnership and friendship with Charlie Munger, and partly through his own experience analyzing and owning businesses over many years. Buffett came to realize that the best investments are not necessarily the cheapest stocks. The best investments are companies with durable competitive advantages that can compound returns at high rates for very long periods. He famously said that it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price, which represents a profound departure from Graham's original emphasis on extreme cheapness as the primary criterion for investment. Buffett's most famous articulation of the competitive advantage concept is his idea of the economic moat, a term borrowed from medieval castle architecture. A castle with a wide, deep moat filled with water is very difficult to attack and very easy to defend. A business with a wide economic moat is similarly very difficult for competitors to challenge and very durable in its ability to maintain high profits over time. Buffett looks for businesses with wide, durable moats that protect them from competition and allow them to earn above normal returns for many years. And crucially, he is willing to pay a fair price for such a business, even if the stock is not particularly cheap by Graham's standards, because the power of compounding means that a business earning very high returns on equity for many years is worth a great deal more than a simple calculation of current assets or current earnings would suggest. One of the most important tools Buffett uses to evaluate a business is the concept of return on equity, which measures how much profit a business generates for every unit of equity capital that shareholders have invested. A business with a consistently high return on equity over many years is generating significant and compounding value for its shareholders. If a business can earn a very high return on equity year after year, and if it can reinvest those earnings at the same high rate by expanding within its competitive moat, the value of the business grows at an extraordinary pace over time due to the magic of compounding returns. But here is the critical question that separates a casual observation from a genuine insight. Can the high return on equity actually be maintained over time, or will it erode as competition intensifies? This is where competitive advantage analysis becomes absolutely essential. A high return on equity is only sustainable if the company has a durable competitive advantage that prevents competitors from eroding its profitability. Without a competitive advantage, high returns will inevitably attract competition, capacity will expand, prices will fall, and those returns will be driven down to normal levels within just a few years. The value investor's job is to identify companies with high returns on equity and then determine, through rigorous analysis, whether those returns are protected by a genuine, durable competitive advantage, or whether they are temporary and destined to disappear. Buffett is also famous for his emphasis on understanding the business itself in qualitative terms, not just the numbers on the financial statements. He wants to understand how a business makes money, why its customers choose it over competitors, what could go wrong over time, and what kind of management is running it. He has often said that he looks for businesses that could be run by an idiot, because eventually one will be. This reflects his deep belief in the importance of a strong, durable competitive advantage that is built into the very structure of the business itself, not dependent on the brilliance or extraordinary effort of any particular management team. On the topic of management quality, Buffett places great importance on honesty, integrity, and skill in capital allocation. He has often said that he looks for three qualities in managers, which are intelligence, energy, and integrity, but that if they do not have the last one, the first two will hurt you. A brilliant and energetic manager who lacks integrity will use their intelligence and energy to serve themselves at the expense of shareholders. An honest manager who lacks brilliance may run a mediocre business, but at least shareholders can trust that their money is being used in their interest and not being diverted to benefit the manager personally. The ideal situation is a brilliant, energetic, and honest manager running a business with a strong competitive advantage, and Buffett has shown a remarkable ability to identify such combinations and to attract such people to his organization. Greenwald also spends considerable time explaining how Buffett evaluates the capital allocation decisions of management, because this is one of the most important determinants of long-term value creation for shareholders. Capital allocation is the process of deciding how to use the earnings a business generates. A business can reinvest those earnings in expanding the business. It can pay them out as dividends to shareholders. It can buy back shares in the company, or it can make acquisitions of other businesses. The quality of these decisions, made consistently over many years, is enormously important to the long-term value created for shareholders. A management team that consistently allocates capital wisely, reinvesting only in projects that earn returns well above the cost of capital, and returning excess capital to shareholders when attractive internal opportunities are not available, will create far more value over time than a management team that reinvests earnings in low-return projects or pays too much for acquisitions driven by ambition rather than discipline. Buffett has always been very clear that capital should only be reinvested in the business if those reinvestments can earn returns above the cost of capital. If a business cannot find good ways to reinvest its earnings at attractive returns, it should return that capital to shareholders through dividends or share buybacks rather than waste it on value-destroying expansion. This discipline is rare among corporate managers, who often prefer to grow their empires for reasons of prestige or competitive instinct, even when the returns on that growth are mediocre. Now let us look at some of the other great value investors who are examined in Greenwald's framework, because each of them offers unique and instructive insights into how the principles of value investing can be applied in different ways and different contexts, revealing the flexibility and adaptability of the core philosophy. Walter Schloss is one of the most inspiring stories in all of investing history, and his story deserves extended attention because it offers lessons that are available to investors of all backgrounds and resource levels. Schloss worked directly for Graham at the Graham-Newman Partnership and learned the principles of value investing from the master at first hand. When he went out on his own, he applied those principles with extraordinary consistency and discipline for nearly 5 decades, generating returns that are almost unbelievable over such an extended time period. What makes Schloss particularly inspiring is that he achieved these remarkable results without any of the resources that many investors assume are necessary for outstanding investment performance. He did not have a large team of analysts researching companies on his behalf. He did not have sophisticated computer models performing complex quantitative analysis. He did not have access to management teams or private information unavailable to ordinary investors. He worked alone, from a small office, relying entirely on publicly available financial information and the principles of value investing that Graham had taught him. His story is a powerful demonstration that the principles of value investing work regardless of the scale of resources you have access to, as long as you apply them with consistency and discipline over a long period. Schloss's approach was essentially pure Graham, carried forward into a later era. He looked for stocks that were trading at very low prices relative to their book value, their asset value, and their earnings. He was not particularly interested in the quality of the business or the brilliance of the management team. He was looking for statistical cheapness, stocks that were so mathematically undervalued relative to their fundamentals that the odds were strongly in his favor that they would eventually rise to a more reasonable price as the market recognized the disconnect between price and value. He diversified widely, owning many stocks at once, sometimes 100 or more, so that even if some of his picks turned out to be disappointments or actual value traps, the overall portfolio would still generate excellent returns due to the large number of winners in the mix. Schloss's story is also a powerful demonstration of the principle that consistency and discipline applied over a long enough time period can generate extraordinary results regardless of the approach taken or the resources available. He did not try to be clever or sophisticated. He did not try to find the most exciting businesses or predict which industries would be the fastest growing. He simply applied a proven system year after year with patience and discipline, and the results compounded into an outstanding long-term record that puts most sophisticated institutional investors to shame. Mario Gabelli is another investor featured in Greenwald's work, and he represents a somewhat different and very practical approach to value investing that has proven enormously successful over many years. Gabelli's specialty is identifying what he calls the private market value of a business, meaning the price that a sophisticated and well-informed buyer would pay to acquire the entire business in a private transaction if it were offered for sale today. The idea is that the stock market often values businesses at prices that are significantly below what a rational, informed buyer would pay to own the entire company outright, because the stock market is driven by short-term thinking and emotional reactions, while a strategic buyer is focused on long-term value. By identifying this gap between the public market price and the private market value, Gabelli finds investment opportunities where the downside is limited and the potential for gain is significant. The logic is compelling. If a business is worth a certain amount in a private transaction between informed parties, then it should eventually trade at close to that value in the public market as well, either because the public market recognizes the value over time, or because a private buyer steps in and acquires the company at a price close to its private market value. Gabelli pays particular attention to the catalysts that might cause the stock market to recognize the private market value of a business, because without a catalyst, even a deeply undervalued business can remain undervalued for a very long time. A catalyst is an event or development that causes the market to revalue a stock upward toward its true worth. Catalysts can include things like a merger or acquisition, a management buyout, where management itself decides to take the company private, a major regulatory change that creates new value, the spin-off of a division that was being undervalued within a larger conglomerate, or simply the passage of time as the business continues to perform well and returns capital to shareholders. By looking for businesses that are undervalued and also have a clear and identifiable catalyst for value recognition in the foreseeable future, Gabelli has been able to generate attractive returns while minimizing the risk of being stuck in a value trap for years with no clear path to value realization. Glenn Greenberg represents yet another very different variation on the value investing theme, one that is particularly instructive for investors who prefer depth over breadth and who have confidence in their analytical ability. Greenberg is known for his highly concentrated approach, meaning that instead of owning dozens or hundreds of stocks like Schloss, he owns only a small number of businesses at any given time, sometimes as few as 5 or 10 positions. His philosophy is that truly great investment opportunities are very rare in the market, And when you find one that you understand deeply and are highly confident about, you should invest a significant portion of your capital in it rather than diluting that conviction across dozens of mediocre ideas. By concentrating his portfolio in his very best ideas, Greenberg believes he can generate higher returns over time than would be possible with a widely diversified portfolio that forces every idea to be treated roughly equally, regardless of how confident you are in each one. The logic is compelling in principle. If your 10 best ideas are all highly attractive and you invest equally in all of them and in 40 more that are merely okay, the 40 mediocre ideas will drag down the performance of the whole portfolio, even if the 10 best ideas perform brilliantly. Of course, concentration also means accepting higher short-term volatility in the portfolio. If one of your few holdings has a serious problem, the impact on your overall portfolio is much greater than if you own that same position in a portfolio of 100 stocks, where no single holding can make or break the overall result. Greenberg manages this concentration risk by doing extraordinarily deep research on each business he owns before investing. He wants to know everything about a business, understanding its competitive position in exhaustive detail, its financial strength and flexibility, the quality and integrity of its management team, and all the major risks it faces, both from competitors and from broader economic and technological changes. By doing this level of deep research, he believes he can reduce the risk of a catastrophic mistake in any of his holdings to an acceptable level, making the concentration worthwhile. Paul Sonkin is another investor who demonstrates the breadth and adaptability of value investing principles by applying them in a specific corner of the market that most institutional investors ignore completely. Sonkin focuses on micro-cap stocks, which are very small companies whose total market value might be only a few tens of millions of units. These companies are so small that most institutional investors cannot buy them in meaningful quantities without pushing the stock price significantly higher during the purchase process and pushing it significantly lower when they try to sell, which makes them impractical as investments for large funds. As a result of this institutional limitation, micro-cap stocks are often very poorly researched and very poorly understood by the investment community. There may be no analyst reports available on them at all. The companies themselves often have limited resources for investor relations. Information about them can be hard to find and hard to verify. This creates enormous opportunities for patient, diligent investors who are willing to do the hard work of understanding these tiny businesses from scratch, because the lack of competition from institutional investors means that mispricings can be extreme and can persist for much longer than they would in larger, more heavily followed stocks. Sonkin's approach involves intensive research into businesses that most people have never heard of, searching for ones that are significantly undervalued relative to their assets or earnings, and that have identifiable paths to value recognition. Because these businesses are so small and so overlooked, they can sometimes be purchased at prices that seem almost absurdly low relative to their fundamental value. The challenges are real. These businesses are illiquid, meaning they can be difficult to sell without moving the price significantly if you need to exit your position quickly. They often have limited publicly available financial information compared to larger companies, and they can sometimes have governance issues or transparency problems that are less common in larger, more scrutinized companies. But for investors who can deal with these challenges patiently and carefully, the microcap world can be a rich hunting ground for value opportunities that the broader market has completely overlooked. Michael Price is another important name in value investing, known particularly for his work at the Mutual Series Fund over many years, and he represents a distinctive approach to value investing that involves going where most investors are too frightened to go. Price is famous for his willingness to invest in distressed situations, including companies that are in severe financial difficulty or actively going through bankruptcy proceedings. These are situations that terrify most ordinary investors because they are complicated, uncertain, legally complex, and potentially very risky in ways that are hard to quantify. But Price recognized that in these situations of maximum fear and uncertainty, some of the most dramatically undervalued opportunities can be found because the market prices them as if the worst possible outcome is inevitable, while the reality is often that value can be recovered through a restructuring or reorganization process. When a company goes into financial difficulty, its stock price often collapses to levels that reflect the fear of total loss. But if the company's underlying business is still viable, and if the financial difficulties can be resolved through a restructuring that reduces debt, closes unprofitable divisions, or brings in new capital, the actual recovery for investors who bought at the bottom can be extraordinary. Price developed a deep expertise in understanding the claims of different creditors and security holders in complex restructuring situations, and he used this specialized knowledge to find situations where he could buy claims at very low prices that would ultimately be settled for significantly more once the restructuring process was completed. This kind of specialized knowledge creates a genuine information advantage that is very difficult for generalist investors to replicate, which is exactly why such opportunities tend to be so attractively priced. Price is also known for his willingness to be an activist when that was necessary, meaning his willingness to engage directly with company management, to push for changes in strategy or leadership, or even to advocate for a sale of the company when he believed that doing so would unlock significant value for shareholders. This kind of shareholder activism is another way that value investors can accelerate the realization of the value they have identified rather than simply waiting passively for the market to come around on its own. Rather than waiting and hoping, the activist investor takes steps to make the recognition of value happen more quickly and more reliably. These different approaches, from Schloss's pure statistical cheapness to Buffett's focus on franchise quality, from Gabelli's private market value approach to Price's activism and distressed investing, all share a common and fundamental foundation in the principles that Graham established nearly a century ago. They all focus on finding businesses where the price being paid is significantly less than the real underlying value of the business, measured in some thoughtful and rigorous way. They all emphasize the importance of a margin of safety as protection against the inevitable uncertainty and error that comes with any attempt to value a business. They all rely on careful, patient analysis rather than speculation, market timing, or following the crowd. And they all demonstrate that the principles of value investing are flexible enough to be applied in many different ways, by many different personality types, in many different market environments around the world. Let us now spend some time on one of the most important concepts in all of value investing, which is the margin of safety. This concept is so central to Graham's philosophy that he devoted extensive discussion to it as the essential protective principle for any serious investor. The margin of safety is the difference between the price you pay for a stock and the estimated intrinsic value of that stock. If you believe a stock is worth 100 units and you pay 50 units for it, your margin of safety is 50 units. The larger the margin of safety, the less you can be hurt if your estimate of intrinsic value turns out to be wrong in some important way that you did not anticipate. And here is the key insight that Graham had, which comes from decades of hard experience, analyzing businesses, and watching even the best investors make mistakes. Estimates of intrinsic value are never perfectly accurate. Even the most careful and sophisticated analysis will sometimes produce an estimate that is significantly wrong. A business that looked extremely healthy might have hidden problems that only emerge later, perhaps a new technology disrupting its core market, or a key customer deciding to bring production in-house, or a regulatory change that undermines its competitive position. A competitive advantage that seemed very durable might turn out to be more fragile than it appeared. A management team that seemed excellent might make serious mistakes or be corrupted by the pressures of success. For all of these reasons, Even the most careful investor will sometimes be wrong about the value of a business. The margin of safety is protection against being wrong. If you buy at a price that is significantly below your estimate of intrinsic value, you have room for error in your analysis. Your estimate of value might be too high. Perhaps your assumptions about competitive advantage durability were too optimistic. But if you bought at a significant enough discount, the investment can still work out well, even if your estimate was somewhat inflated above the true value. The margin of safety principle also implies that investors should avoid paying prices that require everything to go right in order to make a reasonable return on their investment. If you pay a high price for a stock, assuming that the company will continue to grow rapidly for many years and that its competitive advantage will remain perfectly intact, you are exposed to enormous risk if the growth slows, if competition intensifies, if the economy enters a recession, or if any number of other adverse developments occur. Any of these things could cause the stock to fall sharply from a high initial price, and if you paid a high price to begin with, you have very little cushion to protect you from that decline. Value investors always want a cushion. They want to buy at prices where even if things go somewhat badly, they will not lose a significant amount of money, and where if things go normally or well, they will make excellent returns. The concept of margin of safety is closely related to another important principle that distinguishes sophisticated value investors from ordinary ones, which is the focus on permanent loss of capital rather than short-term price fluctuations. Many investors confuse volatility, meaning the short-term swings in price that can be dramatic and frightening, with risk, meaning the permanent loss of money that can never be recovered. A stock that falls in price by 40 units in 1 year is not necessarily risky in any meaningful sense. If the underlying business is sound and you bought it at a very low price relative to its intrinsic value. In fact, a price decline like that might be an outstanding opportunity to buy more of a great business at an even better price and with an even larger margin of safety. The real risk is not that a stock will fluctuate in price in the short term. The real risk is that you will pay too much for a business and that the business will fail to generate the returns you need to justify the price you paid, resulting in a permanent diminishment of your capital that no amount of waiting will ever reverse. This distinction between price volatility and permanent capital loss is one of the most important mental shifts that an investor needs to make in order to become a successful value investor, and it is one that most investors, including most professional investors, never fully make because the emotional pull of short-term price movements is so powerful. Most investors, including most professional investors, focus primarily on price. They watch their portfolios constantly. They are acutely aware of every price movement, and they make decisions based on whether prices have been going up or down recently. Value investors focus primarily on value. They care much more about what a business is worth than about what its stock price has been doing recently. They are actually comfortable seeing prices fall on businesses they want to own more of, because lower prices mean better opportunities with larger margins of safety. Warren Buffett has expressed this idea with his famous analogy about hamburgers. If you eat hamburgers every day and you love hamburgers, you want the price of hamburgers to be as low as possible. When the price of hamburgers falls, you are pleased because you can buy more excellent food for less money. You do not feel upset when hamburger prices fall and wish that you had not started eating hamburgers. It is exactly the same with stocks, Buffett argues. If you are a long-term investor who plans to keep buying stocks for many years, you should want prices to be low so you can buy more of the businesses you believe in. Price declines are your friend, not your enemy, as long as you are confident that the underlying businesses remain sound and that the competitive advantages you identified when you bought are still intact. This attitude toward price declines requires a very specific kind of psychological makeup that is not natural for most people. It requires the ability to stay calm and even cheerful when everyone around you is panicking about falling prices. It requires the confidence to trust your own analysis when the market is loudly telling you that you are wrong through its relentless price declines. It requires patience to wait for the market to come around to your view, which can sometimes take years rather than months. And it requires the intellectual honesty to recognize when your analysis actually was wrong, as opposed to simply being early, because these two situations, being early and being wrong, can look identical in the short term, but require completely different responses. These psychological qualities are just as important as any analytical skill in value investing, and they are, unfortunately, quite rare among investors of all experience levels. Graham wrote extensively about the psychology of investing, recognizing that most investment mistakes are not the result of faulty analysis, but of emotional reactions to market conditions. And Greenwald builds on Graham's insights to help investors understand the emotional challenges they will face and develop strategies for managing them effectively. One of the most important psychological challenges is the temptation to follow the crowd. When everyone else is buying enthusiastically, it feels safe and comfortable to buy too, because you have the reassurance that other people agree with you. When everyone else is selling desperately, it feels dangerous and foolish to hold on or to buy more, because you are swimming against a very powerful current. But the crowd is often wrong, especially at the extreme points where emotions run highest. The times when everyone is most enthusiastic about buying are often the worst times to buy, because that enthusiasm is usually already reflected in high prices that leave little room for the business to disappoint. And the times when everyone is most desperate to sell are often the best times to buy, because that desperation is usually reflected in prices that are far too low relative to the underlying value of the businesses. The value investor must therefore develop what Buffett calls the disposition to be greedy when others are fearful, and fearful when others are greedy. This sounds simple when stated as a principle, but it is one of the most psychologically difficult things to actually do in practice, because it means acting in direct opposition to the powerful social pressure of the crowd and the emotional resonance of market narratives. Developing this contrarian mindset is a lifelong process of self-awareness and emotional discipline, and it is one of the most important things that separates genuinely great investors from average ones over the long run. Another important psychological challenge is dealing with the inevitable mistakes that every investor makes, no matter how experienced or skilled they are. No matter how careful and thorough your analysis, you will sometimes be wrong. A business that looked extremely attractive will turn out to have hidden problems that you did not identify or weight properly. A competitive advantage that seemed durable will turn out to be more fragile than it appeared as new technology or new competitors emerge. A management team that seemed excellent will make serious strategic mistakes or prove to have undisclosed personal failings. These things happen to every investor, including the very best ones in history. The question is not how to avoid all mistakes, because that is impossible even for the most skilled investor, but how to manage them appropriately when they occur. The value investor's approach to mistakes is guided first by the margin of safety principle. Because you bought at a significant discount to your estimated intrinsic value, even a significant overestimate of value will not necessarily result in a permanent loss. But when a mistake is clear and undeniable, when it becomes evident that the underlying business is fundamentally worse than you understood at the time of purchase, in ways that will not recover, the right response is usually to cut your losses and move on, rather than holding on and hoping that things will improve. Holding on to a deteriorating business simply because you hate to admit that you made a mistake is one of the most destructive and common behaviors in investing. The emotional cost of admitting you were wrong is real, but it is far less than the financial cost of holding on to a failing investment for months or years out of pride or stubbornness. The best investors are able to distinguish quickly between situations where the market is simply being irrationally pessimistic about a sound business that has temporarily disappointed expectations, and situations where the market is correctly recognizing that the underlying business has genuinely deteriorated in ways that will be difficult or impossible to reverse. On the other hand, many investors make the costly mistake of selling good businesses too early simply because the price has risen significantly from where they bought it, and they feel uncomfortable holding something that has already appreciated a lot. They worry that the gain will disappear, and they want to lock it in. This is the wrong way to think about investments in genuinely great businesses. The question is never whether the price has gone up or down from where you bought it. The question is always whether the current price is still attractive relative to the current intrinsic value of the business. If a business's intrinsic value has grown along with or faster than its stock price, it may still be an excellent investment, even if the stock has already risen significantly. Selling a great business simply because it has gone up is a costly mistake that deprives investors of the full benefit of owning wonderful compounding machines for the long term. Let us now turn to the practical question of how a value investor finds investment opportunities in the first place, because the analytical framework is only useful if you can identify businesses worth analyzing. The process of finding investment opportunities involves moving from a large universe of potential investments to a small number of specific positions, and it requires both systematic screening and genuine knowledge of specific industries and businesses. The first step is to define the universe of businesses you are willing to analyze. For most investors, this means focusing on areas where you have some genuine knowledge or expertise, what Buffett calls your circle of competence. Buffett has always been very clear that he only invests in businesses he truly understands in depth, and he has been willing to miss many investment opportunities in industries he does not understand, such as technology companies in the early days of the Internet revolution, because he did not feel confident that he could evaluate their competitive advantages and long-term prospects with the accuracy required to invest with genuine conviction. By staying within your circle of competence, you reduce dramatically the risk of making a catastrophic mistake because you thought you understood something that you actually did not understand nearly as well as you believed. Once you have defined your universe of businesses you are qualified to analyze, the next step is to screen for businesses that appear to be potentially undervalued relative to their fundamentals. This involves looking for quantitative signals of cheapness, such as low price-to-book ratios, low price-to-earnings ratios, low price-to-cash flow ratios, high dividend yields, or stocks trading near their 52-week lows. These quantitative screens do not tell you that a business is definitely undervalued, but they do identify businesses that are worth a closer look because they have the surface-level characteristics of cheap stocks. Many of the most attractive value opportunities will appear in screens like these, because the businesses that are cheapest relative to their fundamentals are often the ones that the market is most pessimistic about, and market pessimism frequently overshoots reality by a wide margin. The businesses that appear in these screens are often there because something bad has happened. Perhaps earnings have disappointed, or the industry is going through a difficult period, or management has made a mistake. But these temporary or reversible problems are often the very source of the opportunity, because the market tends to extrapolate current bad news far too pessimistically into the future. After identifying candidates through quantitative screens, the next step is the hard analytical work of deep fundamental analysis. This means reviewing all available financial reports carefully and critically, understanding how the business actually makes money in the real world, evaluating its competitive position honestly, assessing the quality and incentives of management, and ultimately arriving at a rigorous estimate of intrinsic value based on asset value, earnings power value, and franchise value. This process can take weeks or even months for a complex business, and it is where the vast majority of the analytical effort must be concentrated to produce a genuinely reliable judgment. Greenwald emphasizes the importance of doing this analysis rigorously and honestly, without letting enthusiasm or wishful thinking unconsciously color the assessment in a favorable direction. It is very easy, once you have become interested in a business and have spent time studying it, to unconsciously look for evidence that confirms your initial positive impression and to discount or minimize evidence that suggests problems or risks. This confirmation bias is one of the most common and most costly analytical mistakes in all of investing. The antidote is to deliberately look for the reasons why an investment might go wrong, to construct the most compelling possible case against the investment before making a final decision to invest. If you cannot find any good reasons why an investment might disappoint, you have probably not looked hard enough or been honest enough with yourself. Once you have completed your analysis and arrived at an estimate of intrinsic value, the final step is to compare that estimate to the current market price. If the current price is significantly below your estimate of intrinsic value, providing an adequate margin of safety, you have found a potential investment opportunity worth acting on. If the current price is close to or above your estimate of intrinsic value, you should either wait for a better price to emerge before investing or move on to analyze other opportunities in the market. The discipline to wait for an adequate margin of safety, even when you love a business and are very excited about its prospects, is one of the most important and most challenging qualities of a successful value investor. Many investors ruin otherwise excellent ideas by paying too much in their eagerness to get invested. Portfolio construction is another important topic that Greenwald addresses in his framework. Once you have identified a set of attractive investment opportunities, how should you allocate your capital among them? This is a question that different successful value investors answer in very different ways, depending on their confidence in their ability to identify individual opportunities, their tolerance for short-term portfolio volatility, and the breadth of their knowledge base. At one extreme, investors like Schloss prefer to hold very large numbers of positions, sometimes 100 or more, with relatively small amounts in each individual position. This approach accepts the reality that any individual investment analysis might be wrong in some important way, and it relies on the mathematical principle that a large portfolio of statistically cheap stocks will, on average, generate excellent returns even if many individual stocks disappoint, because the ones that work out will more than compensate for the ones that do not. The advantage of this approach is that it reduces the impact of any single mistake to a very manageable level. The disadvantage is that it inevitably dilutes the benefit of your very best ideas by spreading capital equally across many ideas of varying quality. At the other extreme, investors like Greenberg prefer to hold very few positions, sometimes as few as 5 or 10, with large amounts committed to their best ideas. This approach maximizes the positive impact of the ideas you are most confident about and eliminates the dilution effect of holding many mediocre ideas alongside a few great ones. The advantage is that it allows your best ideas to have a large positive impact on your overall returns when they work out as expected. The disadvantage is that it increases the impact of any single mistake to a level that can meaningfully damage the overall portfolio. Most successful value investors fall somewhere in the middle of these two extremes, holding perhaps 15 to 30 positions. This provides enough diversification to protect against catastrophic mistakes on individual positions, while still allowing the best ideas to have a meaningful positive impact on the portfolio's overall returns. The right number of positions will depend on individual circumstances, personality, and the breadth of one's analytical capabilities. Regardless of how many positions you hold, the common thread among all successful value investors is that each and every position must represent a genuine investment opportunity with an adequate margin of safety. Many investors make the costly mistake of adding positions simply for the sake of diversification, even when they do not have genuine conviction in those additional positions based on thorough analysis. Every position in a disciplined value investor's portfolio should be there because it represents a genuine opportunity supported by careful analysis, not because the investor felt they needed to fill a quota of positions or felt uncomfortable with the concentration of their best ideas. The question of when to sell is just as important as the question of when to buy, and it is an area where even experienced investors often make significant mistakes. There are essentially three clear reasons to sell a position in a value investing framework. The first is that the stock price has risen to or above your estimate of intrinsic value, meaning the margin of safety has disappeared and the investment is no longer particularly attractive compared to what else is available. The second is that you have found an even more attractive investment opportunity and you need to free up capital to fund it, making it rational to sell a position that is merely fairly valued in order to fund one that is significantly undervalued. The third is that your original analysis was wrong in an important way, meaning the business is fundamentally worse than you believed when you invested, and you need to acknowledge the mistake and cut your losses before they grow larger. One of the most important aspects of Greenwald's comprehensive framework is the role that industry analysis plays in the overall process of evaluating a business's competitive position and the durability of its franchise value. Understanding the competitive structure of an industry is essential for understanding whether a company's competitive advantage is likely to be durable over the long term, or whether it is vulnerable to erosion from forces that may not be immediately obvious. Greenwald draws heavily on the work of Michael Porter, the Harvard Business School professor who developed the famous Five Forces framework for analyzing industry competitiveness, and he integrates Porter's insights into the value investing framework in ways that make them directly applicable to investment decisions. Porter's five forces are the threat of new entrants into the industry, the bargaining power of suppliers to the companies in the industry, the bargaining power of buyers who purchase from the companies, the threat of substitute products or services that could displace the industry's offerings, and the intensity of rivalry among the existing competitors in the industry. The threat of new entrants is perhaps the most important of the five forces for value investors to understand and evaluate carefully. An industry where it is easy for new companies to enter and compete effectively is an industry where it is very difficult for any individual company to maintain high returns over time, because the high returns attract new entrants who add capacity and drive prices and margins down. Industries where entry is very difficult or very expensive due to regulatory barriers that require extensive approvals, high capital requirements that limit who can afford to build the necessary infrastructure, strong and established brand loyalty that makes it very hard to win customers away from established players, or powerful network effects that make the incumbent's position stronger with each additional user, are much more favorable environments for existing companies and much more likely to produce businesses with genuinely durable competitive advantages. The bargaining power of suppliers affects how much a company must pay for its inputs, including raw materials, components, and services. If suppliers have a lot of bargaining power, perhaps because there are only a few of them who can provide a critical input, or because the company is highly dependent on a specific input that is difficult to substitute, those suppliers can demand high prices and put continuous pressure on the company's profit margins. Companies that have many alternative suppliers, that can produce their most critical inputs themselves, or that are not dependent on any single critical purchased input, have a significant structural advantage over companies that are dependent on powerful suppliers who can always demand more. Similarly, the bargaining power of buyers affects how much a company can actually charge for its products or services without losing those buyers to competitors. If buyers have a lot of bargaining power, perhaps because they are very large companies that purchase in very high volumes and represent a significant portion of the seller's revenue, or because the product being sold is relatively undifferentiated and buyers can easily switch between multiple suppliers, those buyers can demand low prices and continuous price concessions that squeeze the selling company's profit margins over time. Companies that sell to many small, dispersed customers, where no single customer represents a significant portion of revenues, or that sell highly differentiated products that customers value enough to pay a premium for without extensive negotiation, have a significant structural advantage. The threat of substitute products or services is a force that can undermine apparently strong competitive advantages in ways that are sometimes difficult to anticipate. Even if a company has no direct competitors who offer essentially the same product, it may face the threat of customers switching to a completely different type of product or service that meets the same underlying need in a different way. For example, a newspaper company may have very little direct competition in its local market, but it still faces a profound threat from internet-based news sources that can provide similar or better information at effectively zero cost to the consumer. Understanding the substitution threat fully requires thinking broadly about the underlying need that customers are trying to meet, not just about who else is selling the same type of product. The intensity of rivalry among existing competitors in an industry affects how much companies must continuously spend on advertising, product development, price discounting, and service improvements just to maintain their current market position. Industries where rivalry is intense are generally much less attractive as investment environments than industries where rivalry is limited and contained by mutual restraint or by the structure of the competitive dynamics. Factors that tend to increase rivalry include having many competitors of similar size and strategic position, slow overall industry growth, that means any one company can only grow by taking share from others, high fixed costs that push all companies to maximize volume at the expense of price and margin, and low product differentiation that makes it easy for customers to switch between competitors without loyalty or significant switching costs. By carefully understanding all five of these forces in the specific context of the industry being analyzed, the value investor can assess not just the current competitive position of a specific company, but the fundamental structural attractiveness of the industry it operates in over the long term. The best investments tend to be in companies that operate in industries with favorable competitive dynamics across multiple dimensions simultaneously. High barriers to entry protect the incumbent players from new competition. Limited buyer and supplier bargaining power allows companies to earn attractive margins. Substitution threats are minimal because the product meets a need that cannot be easily satisfied in other ways. And rivalry among existing players is limited and rational rather than destructive. Companies in such industries are much more likely to sustain high returns on capital over long periods of time, which is the foundation of truly great long-term investment returns. Greenwald also discusses how competitive advantages are built over time and how they can erode, which is important for investors to understand because most competitive advantages are not permanent and unchanging. Technology changes and creates new substitutes or reduces entry barriers in markets that were previously well protected. Customer preferences evolve in ways that favor new approaches over established ones. Regulatory environments shift in ways that either protect or open up previously closed markets. New innovations emerge from unexpected directions and create new substitutes for established products. The value investor must think carefully about the long-term trajectory of a competitive advantage, not just its strength at the current moment. This brings up the crucial concept of the value of growth, which many investors fundamentally misunderstand. Many investors assume that growth is always good, that a company growing rapidly is always more valuable than a company growing slowly. But Greenwald shows clearly that this is not necessarily true, and in fact can be false under many circumstances. Growth is only valuable when the returns on the investment required to fund that growth exceed the cost of capital. If a company is growing, but the additional investment required to fuel that growth earns only a normal return equivalent to the cost of capital, then the growth adds no value whatsoever to shareholders. The business is bigger, but it is not worth any more per share than it was before the growth. If the investment required to fuel growth earns less than the cost of capital, which can happen in highly competitive industries where entry barriers are low and competitors pile in to match the growth, then growth actually destroys value. The company is investing its shareholders' money in projects that earn less than those shareholders could earn on equally risky investments elsewhere, making every unit of growth a negative for the true long-term investor. Growth is enormously and powerfully valuable only when a company can grow within the protective umbrella of its competitive advantage, reinvesting its earnings at returns that significantly exceed the cost of capital because the competitive moat prevents competitors from eroding those returns. This is the key insight that explains why Buffett is willing to pay what appears to be a high price for businesses with strong competitive advantages and significant opportunities to grow within those advantages. If a company can reinvest its earnings at very high returns, each additional unit of growth creates enormous compounding value for shareholders over time. This is the opposite of the situation in a highly competitive industry without barriers to entry, where growth requires heavy investment that earns only marginal returns, and where the growth itself attracts more competition. Understanding the relationship between growth and value is one of the most important areas where investors commonly go wrong. They see a rapidly growing company and assume it must be very valuable, without asking the critical question of whether that growth is protected by a competitive advantage or merely attracting competitors who will eventually destroy the profitability. Rapid growth in a competitive industry, where barriers to entry are low, is often a warning sign rather than an attractive opportunity, because the growth attracts competitors who pile into the industry and ultimately destroy the profitability that made the growth look so attractive in the first place. The value investor always looks for growth that is protected and defensible, not growth for its own sake in a field open to all comers. Let us bring all of these concepts together into an understanding of the complete practical framework for how a value investor should approach the task of analyzing a specific business and making an investment decision. The process follows a logical and rigorous sequence that moves from the most certain and reliable valuation method to the most uncertain but potentially most rewarding one. The starting point is always the asset-based valuation. What is this business worth if we look only at what it owns and what it owes, adjusting both for their true economic value as opposed to their accounting value? What would remain for shareholders if the business were liquidated today at fair market prices? This gives the absolute floor of value, the minimum the business is worth, under even the most pessimistic, realistic scenario. If the market is pricing a business at or below this liquidation value, the investor has a very strong margin of safety, because even in the worst case, the investment should not result in a significant permanent loss of capital. From the asset value, the analysis moves to the earnings power value. Given what the business owns, and given what it currently earns with those assets on a normalized, sustainable basis, what is it worth as an ongoing concern? If the earnings power value is significantly higher than the asset value, we know the business is earning above normal returns on its assets, which means it probably has some kind of competitive advantage that needs to be identified, analyzed, and properly valued. From the earnings power value, we move to the franchise value analysis. What is the source of the business's competitive advantage? How durable is that advantage likely to be over the next decade and beyond? What are the genuine threats to it? How much could the business realistically grow within the protection of its competitive advantage at returns above the cost of capital? By carefully answering these questions, we arrive at a comprehensive estimate of the true intrinsic value of the business, including not just the current assets and earnings, but also the substantial future value of a sustainable competitive advantage compounded over many years. Finally, we compare this estimate of intrinsic value to the current market price. If the market price is significantly below our estimate of intrinsic value, providing an adequate margin of safety against our potential analytical errors, we have found a genuine investment opportunity. If the margin of safety is large enough, given the uncertainty involved, we invest with conviction. If not, we wait patiently or move on to analyze other opportunities. Greenwald is careful throughout his work to point out that value investing is not a guarantee of success in any given period. There will always be years, sometimes many consecutive years, when the market favors other approaches, when growth stocks dramatically outperform value stocks, and when the patient, disciplined value investor appears to be falling behind those who chase momentum and pay high prices for exciting stories. The history of value investing includes several such difficult and extended periods when investors who stayed true to the core principles of value investing had to watch speculative stocks rise far above any reasonable estimate of their intrinsic value, while the boring, cheap businesses they owned lagged behind in an environment where only story mattered. These periods test the faith and discipline of even the most committed and experienced value investors. They create strong social pressure to abandon the principles and chase whatever is currently working in the market. Many investors who intellectually understand and believe in value investing abandon it precisely when it is most out of favor, which is usually just before it begins to work brilliantly again. The ability to maintain conviction in a sound investment philosophy during extended periods of apparent underperformance is one of the most important and rare qualities that separates truly great investors from merely competent ones. But over long enough time periods, the evidence strongly and consistently supports the conclusion that value investing works. Stock markets tend to systematically overreact to both good news and bad news. They tend to price rapid growth too optimistically, building in assumptions about how long and how high the growth will continue that the actual businesses almost never live up to. And they tend to price distressed or out-of-favor businesses too pessimistically, assuming that current problems are permanent when they are often temporary and reversible. Over time, these mispricings correct. The hot stocks of today tend to disappoint as competition erodes their competitive advantages and as reality fails to live up to the optimistic expectations that were priced in from the beginning. And the despised, cheap stocks of today tend to surprise on the upside as the businesses prove more resilient than the market expected and as their prices gradually recover toward intrinsic value. By systematically buying businesses that the market has priced too pessimistically and avoiding businesses that the market has priced too optimistically, the disciplined value investor can generate returns that exceed the market over full market cycles and over many years. The evidence for this is compelling and has been studied extensively across different markets and different time periods. Stocks with low price-to-book ratios and other measures of statistical cheapness have outperformed stocks with high price-to-book ratios across many countries, over many decades, and through many different market environments. This value premium has been remarkably consistent even as markets have become more liquid and more efficiently priced in many respects, suggesting that it is driven by deep-seated behavioral biases rather than simple information inefficiencies that could be easily arbitraged away. One of the most important practical lessons from Greenwald's comprehensive framework is the importance of focusing your energy and attention on the parts of the market where you have the best chance of finding genuinely undervalued opportunities. Not all markets and not all segments of the market are equally inefficient or equally open to the value investor's approach. Large-cap stocks in major developed markets, like the United States or the United Kingdom, are followed by hundreds of highly skilled and well-resourced analysts, and they are priced very efficiently most of the time. Finding a genuinely undervalued large-cap stock in these markets is extremely difficult because so many sophisticated investors are already looking at these stocks intensively, and any obvious mispricing tends to be quickly identified and corrected. The best opportunities in value investing tend to be in the less followed and less loved corners of the market, including small cap and micro cap stocks that institutional investors cannot buy without disrupting the market. International markets in countries where fewer sophisticated investors are paying attention, out-of-favor industries that everyone has given up on and nobody wants to discuss, and special situations like spin-offs, bankruptcies, and restructurings that require specialized knowledge to analyze properly and that most generalist investors avoid due to their complexity. This insight about where to look for opportunities is important because many investors try to compete in the most competitive parts of the market, where thousands of brilliant and well-resourced analysts are all looking at the same stocks with access to the same information and the same management teams. In this environment, finding a genuine analytical edge is extremely difficult, and the occasional edge you do find is usually very small. The better approach, for most investors, is to focus on the parts of the market where competition for information and analytical insight is less intense, where patient and diligent research can reveal opportunities that well-resourced but less patient investors have overlooked or dismissed. Another fundamental lesson from Greenwald's framework is the irreplaceable value of patience in value investing. Value investing is not, and never has been, a quick profit approach. It requires the genuine willingness to wait, sometimes for years, for the market to recognize the value that you have identified through your analysis. Benjamin Graham used to say that in the short run, the market is a voting machine, reflecting the temporary popularity of stocks based on human emotions and current narratives. But in the long run, the market is a weighing machine, reflecting the actual economic value of businesses as that value is realized through cash flows, dividends, and corporate actions over time. The value investor's job is to identify the gap between what the voting machine says today and what the weighing machine will eventually say, and then wait patiently and confidently for that gap to close as it eventually must. This patience has both a practical and an emotional dimension that must both be managed carefully. Practically, value investing often involves holding positions for several years before they fully realize their potential, because the businesses that are cheapest are often cheapest because something has recently gone wrong, and these problems often take significant time to resolve and even longer for the market to acknowledge the resolution. The value investor must be willing and psychologically able to hold through these periods of apparent underperformance, trusting in the analytical work they have done and in the proven power of the underlying principle. Emotionally, patience in investing is extremely difficult because we are constantly and inescapably bombarded with information about what markets are doing today, what analysts are recommending about specific stocks, and what the most exciting investment themes and narratives of the current moment are. This constant flow of information creates a persistent pressure to act, to buy what is currently working and sell what is not, to chase performance rather than value. The value investor must develop the mental discipline to filter out most of this noise and focus consistently on the fundamental question of whether the businesses they own are worth significantly more than the market is currently pricing them at. Warren Buffett has articulated this idea with his famous punch card analogy. He has said that he could improve the returns of most investors by giving them a card with 20 holes in it, representing 20 investments they could make in their entire investing lifetime. With only 20 lifetime investments available, every investor would think with extraordinary care before making each one, rather than being tempted to trade constantly in reaction to every piece of news or market movement. They would focus only on the very best opportunities available to them, invest with high conviction when they found such opportunities, and then wait patiently for those investments to mature and deliver their full potential. Most investors would dramatically improve their long-term results by making far fewer investment decisions, thinking much more carefully about each one they do make, and holding their best ideas for much longer than they currently do. This brings us to one of the most fundamental and clarifying distinctions in Greenwald's work, which is the distinction between genuine investing and speculation. Investing, in the sense that Graham and Greenwald use the term, means buying a stake in a real business at a price that is supported by careful analysis of that business's fundamental economic value, with an adequate margin of safety to protect against the inevitable errors that come with any analytical process. Speculation, on the other hand, means buying a security primarily based on the expectation that its price will rise in the near future, without necessarily having a clear and well-reasoned view of what the underlying business is worth, or a margin of safety if that expectation of price appreciation turns out to be wrong. Speculators are essentially betting on price movements and on the behavior of other market participants. Investors are buying pieces of real businesses at prices they believe are attractive relative to the fundamental economic value of those businesses. This distinction matters enormously because it fundamentally changes how you respond to market conditions and price movements. The speculator is hurt by price declines and must sell to protect against further losses. The investor may be pleased by price declines because they represent better buying opportunities in businesses that are now available at an even larger margin of safety. These completely opposite reactions to the same market events explain why value investing can feel deeply counterintuitive, especially to those who have been trained to think about investing in terms of price momentum and recent performance. It requires feeling comfortable buying things that have been falling in price and feeling cautious about things that have been rising sharply. These reactions are exactly opposite to what human psychology and social conditioning naturally incline you toward. But it is precisely this counterintuitive behavior, consistently applied, that creates the investment opportunities that value investors exploit over time. Greenwald also addresses the important role of accounting in value investing, which is an area that confuses and misleads many investors because financial statements, while an essential starting point for any fundamental analysis, are not the same as economic reality and must be thoughtfully translated into real economic terms to be useful. One of the most important adjustments involves the treatment of intangible assets and intangible investments. Modern accounting rules require companies to expense many valuable intangible investments, such as research and development, spending on new products, and advertising expenditures that build brand recognition immediately as costs, rather than capitalizing them as assets on the balance sheet over the years that they will benefit the company. This means that a company that spends heavily on building its brand, developing new technologies, or training its workforce will show lower accounting profits than a company that does not make these investments, even though the brand, technology, and trained workforce being built may be extremely valuable to the business's future earning power. The value investor must learn to recognize and adjust for this important accounting limitation. Depreciation is another area where accounting treatment and economic reality often diverge in important ways. Accounting depreciation is a standardized deduction from reported earnings that is supposed to reflect the gradual wearing out of physical assets over time. But actual asset lives and patterns of value decline vary enormously from company to company and from asset type to asset type. Some assets wear out much faster than the accounting depreciation rate suggests, meaning that the company must spend more on maintenance or replacement than the accounting depreciation expense implies. Other assets retain their value much better than the accounting rules assume, meaning that the accounting depreciation overstates the true economic cost of using those assets. These accounting issues are significant because they directly affect the reported earnings that investors use to evaluate businesses. A company that is understating its true maintenance capital expenditure will appear to earn more than it really does on a sustainable basis, and investors who do not understand this will overvalue the business. The value investor who takes the time to understand the true economic reality behind the accounting numbers has a genuine information advantage over investors who simply take the reported figures at face value. Cyclicality in businesses deserves extended discussion because it presents both special opportunities and special hazards for value investors that must be handled with care. Many important industries are highly cyclical, meaning their profitability fluctuates dramatically with the state of the economy or with specific supply and demand dynamics within the industry itself. Commodity businesses, construction companies, steel mills, mining companies, auto manufacturers, and many other types of businesses go through regular and sometimes dramatic cycles of boom and bust that can make evaluating their intrinsic value particularly challenging. Understanding these cycles is crucial for the value investor because the appearance of cheapness or expensiveness can be deeply misleading if you are looking at the financials at the wrong point in the cycle. A company in a highly cyclical industry might appear extremely cheap at the peak of the cycle because its earnings are very high and its price-to-earnings ratio looks very low. But if those high earnings are the result of a cyclical peak that is about to turn, the company is not actually cheap at all. When the cycle inevitably turns down, earnings will fall sharply, and the stock price will likely follow them down, possibly wiping out any gains and creating significant losses. Conversely, a company in a cyclical industry might appear extremely expensive at the bottom of the cycle because its earnings are very low or the company is operating at a loss. But if the company is well managed, financially strong enough to survive the downturn, and will be highly profitable when the cycle turns up again, as it eventually will, the apparent expensiveness based on current depressed earnings is completely misleading. At the bottom of the cycle, when the news is at its worst and most investors are most pessimistic, the company may actually represent an outstanding investment opportunity. Value investors who understand cycles deeply and who have the courage and patience to act on that understanding can make extraordinary profits by buying cyclical businesses at the bottom of their cycles and holding them through the recovery. But this requires the ability to accurately assess where you are in a specific cycle, which is more difficult in practice than it sounds in theory, and the patience to hold through what can be extended and painful periods of poor performance before the cycle turns. As we approach the conclusion of this extensive exploration of value investing, it is worth stepping back and thinking about what makes this approach so enduring and so powerful across different eras and different market environments. Value investing has been a coherent and consistently successful investment philosophy for nearly a century. It has been applied by many different investors with many different personal styles in many different markets and many different time periods. It has survived the Great Depression, the Second World War, the post-war boom, the inflationary decade of the 1970s, the extraordinary bull markets of the 1980s and 1990s, the dot-com crash, the global financial crisis of 2008, and numerous other upheavals of all kinds. Through all of these events and all of these market environments, the basic principles that Graham articulated have remained relevant and effective. Why? Because the fundamental logic of value investing is grounded in an economic reality that does not change regardless of what era you are in. Businesses have real economic value based on their assets and their earning power. Markets, driven by human emotions and behavioral biases that are as old as human psychology itself, sometimes price businesses at levels significantly different from their real economic value. Patient, disciplined investors who can identify these mispricings and wait for them to correct will, over time, outperform investors who chase momentum, follow the crowd, or pay too much for exciting stories with insufficient margin of safety. This logic holds in any market, in any time period, in any economic environment. The specific opportunities will vary across time and geography. The industries and companies that are undervalued will change as economies and technologies evolve. The competitive advantages that create franchise value will evolve as new technologies emerge and consumer preferences shift. But the basic process of identifying undervalued businesses by comparing their market price to their intrinsic value, investing with an adequate margin of safety, and waiting patiently for value to be recognized will always generate superior results for investors who can master both the analytical and the psychological skills it requires over the long term. Greenwald's great contribution to the literature of value investing is not that he invented new principles where none existed before. Graham and Buffett had already articulated the most important principles. Greenwald's contribution is that he organized, extended, and articulated these principles in a rigorous and systematic way that makes them accessible and teachable to serious investors at all levels of experience. By breaking value down into its three components of asset value, earnings power value, and franchise value, and by showing precisely how each component is calculated and what it reveals about a business, Greenwald gives investors a practical and replicable framework that can be applied to any business in any industry with the appropriate adaptations. The work also makes abundantly clear that value investing is not a rigid formula that can be applied mechanically without thought or judgment. It requires genuine analytical insight, creative problem solving, and ongoing learning as industries and businesses evolve. Every business is unique in important ways, and applying the value investing framework to a specific business requires a deep understanding of that particular business's competitive dynamics, its financial characteristics, the motivations of its management, and the specific factors that will determine its future. This is why developing genuine expertise in specific industries and types of businesses, expanding your circle of competence through continuous study and experience, is so important for long-term success as a value investor. For investors who are willing to put in the serious work required to study businesses with genuine depth and intellectual curiosity, to develop real knowledge in specific areas of the economy, and to maintain the discipline and patience that value investing demands through its inevitable difficult periods, the rewards have historically been extraordinary. The investors profiled throughout this exploration, from Graham himself, to Buffett, to Schloss, to Gabelli, to Greenberg, to Price and beyond, have all demonstrated through decades of actual results that the value investing approach can generate outstanding returns over long periods of time. They have done it in different ways, with different personal styles, in different markets, and different time periods. But they have all shared the core commitments that define value investing at its heart: the commitment to buying based on rigorous analysis of fundamental economic value, the commitment to maintaining an adequate margin of safety to protect against inevitable errors, and the commitment to patience and discipline, even when the market is loudly telling you that you are wrong. The world of investing is full of noise, distractions, and temptations that pull investors away from the simple but demanding discipline of value investing. Every day brings new information, new predictions, new exciting narratives about what will happen in markets. Most of this is irrelevant to the long-term investor who is focused on the fundamental question of what businesses are worth and what they are being priced at today. The value investor learns over time to filter out the noise and focus on the questions that really matter. What is this business worth based on its assets, its earning power, and its competitive advantage? What am I paying for it in the current market? What is my margin of safety if my analysis turns out to be imperfect? Does this business have a competitive advantage that will protect its earning power over the long term and allow it to compound value for its owners? These questions are simple enough to state but deeply demanding to answer well, requiring broad financial knowledge, rigorous analytical thinking, genuine business understanding, and the sound judgment that only comes from years of experience. Developing these capabilities is a lifelong process, and the best investors are always learning, always refining their understanding, always looking for new insights that can sharpen their analytical framework and improve their ability to identify genuine value in a noisy and emotional market. If there is one message that comes through with total clarity from this comprehensive exploration of value investing, from Graham to Buffett and beyond, it is this: success in investing is not primarily about being the smartest person in the room, or having access to the most information, or using the most sophisticated quantitative models. It is about having a sound framework grounded in economic reality, applying it consistently over time, maintaining the discipline to stick with it during difficult periods when it seems to be failing, and having the patience to wait for the logic of value to play out over the long time horizons that the market's inefficiency sometimes requires. These qualities are not reserved for genius. They are available to any investor who is genuinely willing to develop them through study, practice, and the sometimes painful experience of real investment decisions made with real money. The principles of value investing, from Graham's original insights to Buffett's profound extensions, to Greenwald's systematic and comprehensive framework, offer a proven path to investment success that has stood the test of time across a century of turbulent and ever-changing markets. The tools are here. The framework is clear. The evidence of their effectiveness is overwhelming and consistent. What remains is for each investor to make the personal commitment to learn these principles deeply, to practice applying them with rigor and honesty, and to maintain the consistency and discipline that the greatest investors in history have demonstrated through every kind of market environment the world has ever produced. The journey from Graham to Buffett and beyond is ultimately a story about intellectual courage and intellectual honesty. The courage to think independently in a world that rewards conformity and punishes dissent. The honesty to acknowledge mistakes quickly and learn from them rather than defend them. The intellectual humility to keep learning and refining your understanding even after you have achieved a high level of skill. And the patience to let the economics of genuine value play out over time, trusting that the market's weighing machine will eventually do its work and recognize the value that your analysis identified. For any investor who is willing to walk this path with genuine commitment, the destination is very much worth every step of the journey.